Well, there are two ways of writing off a car in the U.S. and one way in Canada. In the U.S., you can use the mileage approach or what is known as the actual method. In Canada, it's just the actual. You don't get the mileage. But I'm going to go through it. The mileage is the more conservative number anyway, so you probably just want to use the actual. But to give you an idea of how the mileage works in the United States, IRS gives you 54 cents a mile this year for every mile you drive for business. Now, here's the important point. Who determines how many miles we drive for business? Does the government or do we? And the answer is we do. And how do we do it? From our tax tracker or tax organizer. So, for example, let's say I drive 20 miles, or you drive 20 miles tomorrow for business. You get 54 cents a mile here in the U.S. for a $10.80 deduction. Now, a deduction is not cash. It's an indirect form of cash. In order to figure out how much cash you get from any deduction, I don't care if you're in U.S. or Canada, you have to multiply it by the tax bracket that you're in. So now what does that mean, tax bracket? You know, I say that, you probably heard it, but what does it mean? Is that the average of what you pay? No. Tax bracket is what you pay on the last dollar you make to the federal and state or federal and provincial governments. And if you get a deduction, it's what part of that deduction comes back as a refund. That's why we always want deductions. And there's an old song that we CPAs sing and CAs sing in Canada. You don't want to hear us sing, but the words are great. Everything is cheaper if you get a deduction, cha-cha-cha. So let's say between federal, state or provincial taxes, CPP or Social Security, capital gains, you're in the 33% bracket, which, by the way, is the average tax bracket for people in North America. It could be as high as 54%. For you Canadians, I think it's even higher. It could be, depending on this province and things you're in, it could be 57 or so. But let's say you're in the 33% bracket. Be conservative. You would multiply 33% by the $10.80 deduction. That would put $3.56 in your pocket as a result of that 20 miles of driving. And if you do that 30 days a week, I mean, that's over $100. And by the way, it works the other way, too. If you don't have the right documentation, if you don't have a good tax tracker, it costs you at least this much, and it could be a lot more. Now, so let's say gas is $2.26 a gallon. I think I got paid at $2.25 the other day. And you get 20 miles to the gallon. Not only are you paying for your gas, but you're making $1.30 a gallon, or whatever that translates into per liter. It's actually coming out with a profit. That's why writing off your car is essential, and having good tax tracker is absolutely essential. Now, that's for the IRS method, which is only available in the U.S. The actual method works in both Canada and U.S. So what's the actual method? The actual method is where you take your business mileage divided by your total mileage, and that's the percentage of all your various car expenses that you can write off. That's the percentage of your gas, oil, insurance, wash, wax, and depreciation. And again, who determines how much our business mileage and total mileage is? Who is it? Is it the IRS or Canada Revenue, or do we determine this? We do. And how do we do it? From a tax tracker. Is everybody getting the drift here? Okay. So let's say I put on 20,000 business miles at a 40,000 total. Notice it's not based on months of use. It's based on business mileage to total mileage, even if you only own it for 1 month. That results in a 50% write-off of your various vehicles. So 50% of it should say 11,000. I think we have a typo over here. So 50% of 11,000 would be $5,500. And again, your tax tracker is everything. And by the way, I have people ask me all the time, you make such a big deal about a tax tracker. Will IRS and Canada Revenue Agency believe everything I say in my tracker? Yes. By regulation, they must accept everything you say in your tax tracker. Unless they can prove fraud, they have to accept that. It's like your insurance policy against IRS. You know, I know all of you, and I'm not just talking about a mileage log. I'm talking about an expense log, too. You know, many of you have homeowners insurance. Why? You don't have your house burned down every day. Because if you don't have it and it burns down, it's a disaster. I know every one of you have car insurance. I know you don't get into an accident all the time. In fact, you probably very rarely get into an accident. But if you don't have it, when you have an accident, it's a disaster. Your tax tracker is your audit insurance against IRS. It'll give you that peace of mind of not having to worry about an audit or a Canada Revenue Agent audit again. What's that worth? All right, now one of the documents.
Don't forget to sign up to our upcoming webinar with Sandy on Tuesday, February 21st.